Welcome back to Make a Mill, the channel where we all want to make it to seven figures. So let's get started on that journey right now. Today, got a quick WBD Warner Brothers Discovery stock option update. And why wouldn't you take financial advice from a guy wearing a Beavis and Butthead shirt? And faux pas, apparently Paramount owns MTV, which owns Beavis and Butthead. So I am misrepresenting today. But we're making money today. I just noticed that Warner Brothers Discovery stock was kind of spiking here. As you can see, it just popped off. And it happened to be, if you look back on August the 27th when I wrote this option, and I'll throw a card up, the stock was around $8 when I wrote the option. Now, if you'll notice, when it went down September 8th, a week and a half later, to $7, the probabilities of me losing on the contract went up, and it got closer to the strike, and I went over all that in the other video. And I had an unrealized gain on paper of about $600. Now, critically, you don't have to realize that gain. Now, you would think that, well, the price now is back up above 805. I'm just taking a snapshot from today. Maybe the price at the end of today will be different, but I just took a snapshot. It's at $8.18 right now. Probability in the money, 18.5%. So there's actually a lower chance that the contract will execute than when I first wrote the contract, okay? And that was almost, more than 2 weeks ago. So I am safer now than I was 2 weeks ago. And the price of the stock is higher, which is the reason for that safety. This is higher than when I wrote the contract 2 weeks ago. So what the heck is this minus 950? Why? Why shouldn't it go back towards zero? Shouldn't? No. Well, see, if you look at the Black Scholes formula, the model that describes option pricing models and how that works, one of the inputs is volatility. There's many inputs. There's the stock price. There's the risk-free interest rate. That's the percentage that the Fed funds rate, the percentage that you earn on your idle cash, and that's changing as the economy changes. But one of them is the volatility of the stock, and that means how fast the price moves up and down. So if a stock moves very quickly up and very quickly down, and it's all over the place, the logic, just think of the logic. It tells you, well, that price is pretty unstable, it's pretty unpredictable. So if we write a stock option on this kind of unstable thing, we might have to expect a premium for that volatility. So volatility tends to drive the price of options up. So I'm guessing that is what was going on, that even though the price of my stock, the asset underlying my contract, even though the price of it went up from where I wrote the contract, my realized gain loss went down. Unrealized gain loss went down. So that has to be due to the volatility. Just the fact that the price swung so quickly from down to 7 and then back up above 8, and then maybe it'll drop down to 6 and maybe up to 9, because everything in finance and options and stocks is all statistics. It's all probabilities. It's numbers. It's crunching numbers. That's why I love it. I love to do this stuff. So yeah, I just saw this spike up. I think in technical trading, they call this a flag up or something. They have names for all these moves. I was reading one of those books one day, but I never managed to memorize all of them. Let me know in the comments what you think of that. So I thought I'd explain that it seems crazy, right? You see that the price to strike actually went up, which is the same thing as saying the stock price went up. That the price to strike is 27% almost, whereas it was 25% the day I wrote it, which is just saying same thing as saying the price is 818, whereas it was 805 before. And yet the unrealized, it's okay. That's why you just, sometimes you just have to wait out the market. What's that quote about the irrationality of the market? I have my own version of it. Let me spit that one. It's make sure that the irrationality of the market doesn't outlast the rationality of your investment. I think I'm butchering it, but it's something like that, the market can stay crazy longer than you can stay solvent or liquid is kind of what the truism is there. And the good thing about these is you don't actually have to have liquidity. You actually get money up front, like I told you in the last video, and you kind of have a liability that you might have to close for a loss if you want to, but you might have to collect those shares too later. So please subscribe to the channel. It helps a lot if you like information like this. I just thought I'd share a quick little tidbit, and see you later. Love you.